The FTSE 100 extended its losing streak to 6 consecutive sessions on Monday. Energy shares climbed. Consumer stocks fell. Oil held above $106 a barrel after Brent surged more than 3% to just under $109, its highest in 3 weeks, as peace talks between Washington and Tehran collapsed a second time. U.S. President Donald Trump announced on Saturday that a planned round of negotiations in Pakistan had been canceled, and Iranian forces were reported to have seized 2 vessels near the Strait of Hormuz. Shipping traffic in the strait is showing what analysts called early signs of recovery, but that recovery is fragile. Around a fifth of the world's crude oil and liquefied natural gas normally passes through those waters. SHEL added roughly 1% on the day, buoyed both by the oil price and the announcement of a $16.4 billion acquisition of Canadian shale producer ARC Resources, its largest deal since the BG Group purchase a decade ago. The deal is being read as a signal that major energy companies are abandoning their renewables pivot and doubling down on fossil fuel production. Meanwhile, Claire's closed its final UK stores on Tuesday, shutting more than 1,000 jobs and ending 3 decades on British high streets. The closure landed on the same day Rachel Reeves was reported to be weighing a 1-year rent freeze for private landlords, a measure she had explicitly resisted only months ago. The backdrop then was one of tightening household budgets, war-driven energy costs, and a market that cannot decide whether the next shock will arrive from Tehran, from Threadneedle Street, or from both simultaneously.
Every major central bank in the G7 is expected to hold borrowing costs this week. The Federal Reserve meets on Wednesday. The European Central Bank held at 2% last week, with Standard Chartered warning that a June hike is now a live risk if the Strait of Hormuz remains closed. The Bank of England announces on Thursday. The consensus is a 7-2 hold. That is where the signal sits. JP Morgan, BNP Paribas, and Goldman Sachs have each independently predicted that at least 2 members of the Monetary Policy Committee will vote to raise interest rates, not hold, not cut, raise. The bank's chief economist, Hugh Pill, is expected to lead the push. Over 37 MPC meetings, Pill has voted to raise rates 14 times and backed reductions only twice. He argued as recently as last year that the bank had been too hasty in cutting from the 5.25% peak reached in mid-2023, and that inflation expectations had become structurally embedded after the Ukraine war shock, influencing wage and price-setting behaviors in ways that a single rate cycle could not unwind. That argument was made before Iran. It carries considerably more weight now. UK core inflation cooled to 3.1% in March, but the energy shock from the Strait of Hormuz has not yet fully passed through to consumer prices. Businesses are only beginning to feel the cost of jet fuel constraints, medical supply disruptions, and rising energy bills. A UK government minister stated publicly this week that households face higher prices for at least 8 months after the war in Iran ends, not 8 months from now, but 8 months after a ceasefire that has not yet been agreed. The NHS is on alert over shortages and rising costs for syringes, intravenous bags, and gloves, all of which depend on petrochemicals now held up in the Gulf. Here is what makes those 2 dissenting votes unusual. Central banks traditionally hold during geopolitical shocks, prioritizing growth over inflation containment. That was the pattern after the Ukraine war in 2022, when the Bank of England was criticized for moving too slowly. Pill's argument is that the bank has already made that mistake once. Moving slowly in 2022 and 2023, in his view, left inflation expectations unanchored long enough to influence a full cycle of wage negotiations. He does not want to make that mistake again at the start of a new energy shock. The counter-argument is immediate. Hiking rates into a washock that is already compressing consumer spending and investment would be tightening fiscal and monetary conditions simultaneously, precisely the scenario that caused the UK to briefly lose control of its gilt market in 2022. That episode ended with the bank intervening to buy bonds it had publicly committed to selling. A repeat is not the base case, but 2 MPC members voting to hike before any ceasefire signal would send a message to mortgage markets that the cost of borrowing may not fall as quickly as homeowners had expected. The pound is under pressure heading into Thursday. GBP USD was trading around 1.3545, with selling pressure building ahead of the announcement. Investors are not yet pricing in a hike. That gap between what 2 MPC dissenters may vote for and what markets have priced is the tension that Thursday will resolve or deepen. 2 dissenting votes for a hike, in isolation, change nothing. The overall vote is still expected at 7-2 in favor of holding. Rates will not rise on Thursday. The question is whether those 2 votes are a warning shot or a minority opinion that dissipates if the war de-escalates. The precedent from 2022 is instructive and uncomfortable. When the bank began hiking from near zero in December 2021, the decision was split 8-1.
The lone dissenter voting for a larger hike was later proved closer to correct. Inflation peaked at 11.1%, and the bank was eventually forced into a rapid tightening cycle that pushed the base rate to 5.25% in 14 months. The dissenting votes at the start of that cycle were not noise. They were the signal. The current situation differs in one important respect. The 2022 inflation was demand-driven and supply chain-driven simultaneously. The 2026 shock is almost entirely supply-side, an energy price spike caused by a geopolitical blockade. Supply-side shocks typically resolve faster, and raising rates into one can choke off demand without addressing the underlying cause. The ECB's own dilemma this week captures the same tension. April headline inflation in the Eurozone is forecast at 2.9%, but core is still drifting lower. Tightening to address the headline when the core remains contained risks triggering a recession to solve a problem that will correct itself once the strait reopens. The evidence currently leans towards Thursday producing a hold with 2 dissents, but the language from Pill and the governor's press conference will matter more than the vote count. If the bank signals that further hikes are on the table without a significant improvement in the inflation outlook, mortgage markets will price that in within hours. The threshold to watch is the 2-year gilt yield. If it moves above 4.5% after Thursday's announcement, that is the fixed-rate mortgage market beginning to reprice. If it holds below 4.3%, the hold is being read as genuinely dovish. What breaks the hold scenario is not Tehran, it is wages. If UK wage growth, currently running above 5%, does not cool in the April labor market data due in mid-May, Pill's minority position becomes harder for the full committee to dismiss. That is the data point that could shift a 7-2 hold into something closer to a genuine debate about the direction of policy, and that is the question Thursday's vote will leave open, not close.